Welcome to my channel where I try to break down accounting and tax topics to help small business owners, taxpayers, or anyone else who's just genuinely curious. The new 1099-K rule went into effect on January 1st of this year. So if you make more than $600 with payment processors, you'll likely get a 1099 next January. However, if you're self-employed and you receive a 1099 this year, you may be asking yourself, what exactly do I have to do with it? Well, it's pretty easy. You shouldn't have to do anything. No, seriously, go ahead, toss it. Well, don't actually toss it. So throughout the year, you should have been tracking your revenue in a spreadsheet or in something like QuickBooks if you're serious about your business. Having something like QuickBooks makes all the difference. You can record your sales, invoice clients, balance your books, run payroll, issue 1099s, because if you got to record a 1099, so does your contract help. When you make a sale, you should record it. Sell a sticker on Etsy, record it. Sell an ebook on Amazon KDP, record it. Recording it just means to document it in your revenue. So if you're running a spreadsheet, just add a line. If you're using an ERP like QuickBooks, then go ahead and record the sale. So at the end of the year, you shouldn't have to record any additional revenue because you've already done it throughout the year. The 1099 would purely be informational and something you could just file away. Now what it does do is it allows the IRS to get a glimpse behind the curtain to see how honorable you really are. Just as you get your 1099s, the IRS will get that information as well. They will tally them up and compare them to your taxes to see if everything jives. A huge red flag would be if you have 1099s that add up to greater than your income. That's a dead giveaway that you're committing tax evasion. And just so you know, the federal judicial system doesn't play about tax evasion. I don't know about y'all, but I don't have any plans to spend any time at Club Fed. Now, don't fret. 1099 is purely revenue. You don't pay taxes on revenue, you pay taxes on net income. So you would calculate your net income on Schedule C, Form 1040. As a side note, I do have a separate video where I go through line by line on how to fill one out if you've never done it before. But just to summarize, your 1099 would be included in line 1 of Part 1 on Schedule C. I also have a separate video on the new 1099-K rule, but I honestly think it's going to help a lot more people than it hurts if they use it to their advantage. So if you ran a small business and you never claimed the businesses on your taxes, you likely missed out on tax deductions. See, being self-employed opens up a whole new world of tax benefits. Like you can write off a portion of your home office, your cell phone, your meals, mileage, travel, etc. The opportunities are endless. So if you play your cards right, you could potentially wipe out all the income and end up not paying taxes on it anyway. And you could even offset some W-2 income, which would be your job. But you have to be careful because if you run losses through your business year after year, the IRS could deem your business a hobby, and there are different rules for hobby. Or even worse, they could consider you as evading taxes, like we talked about earlier. It's definitely worth having a professional go over passive activity rules to give you a better understanding and to determine if you are actually running a business. But I say all that to say, what you would do with a 1099 is generally nothing. If you still have questions about a 1099, go ahead and drop them in the comments, and I'll see you in the next video.